Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for November 30th, 2021. I'm Ken Adamo, Chief of Analytics at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning, guys.
Good morning.
So we have Dean, who's jet lagged, coming back from Australia last night, right, Dean?
Correct. Yep, just landed late last night.
And we have Ned, who's doing a bunch of gloating because it's pushing 70 degrees in Portland this week while it's snowy out here in the east. Yeah. And I'm wearing my first of my ugly Christmas sweater collection. I actually have to pick which ones I'm going to wear because there's only a few shows now between now and Christmas. But we should set a date where we all do ugly sweaters over the next couple of weeks.
Yeah, I got a bunch.
I have one. Yeah, I've got one that's my typical DAT Christmas party sweater, but there's not a DAT holiday party sweater. But there's no holiday party this year, so it seems like an apt moment to drag it out.
At least not in Portland.
Not in Portland.
Yeah, so I gotta plan out what I'm going to wear. We also probably need to set up some kind of wager because it's looking like, unless Oregon really misses the mark this weekend, we could see a rematch of Oregon and Ohio State in the Rose Bowl this year. So some sort of friendly wager, I have to imagine, would be appropriate. Maybe get Weaver on the show and wear a Ohio State jersey.
I can't. No, I think that's absolutely what you should do. I'll start putting the screws to old Weaves.
Well, they got to beat the Utes first.
50% chance, or 49%. I saw this morning. You know.
Yeah. Well, enough banter. We're a little holiday hangover here. I haven't been here in a few weeks, so I'm a little rusty.
Right.
So for those less familiar, we're here most weeks talking about the freight markets, what we're seeing, what's happening out there, looking at some data, but most importantly, answering your questions. And I know we've been gone for a little bit, so if you have any pent-up questions or just general comments or thoughts or kind of comments on the college football environment, please drop them in the comment section below. Our dedicated marketing team will forward them over to us as we move along, and we'll answer them at the end. So with that, I'm going to jump into our key trends for the week. I'll caveat everything we're about to say as part of this show with, remember, Thanksgiving was last week. It kind of throws a monkey wrench into just about everything. So keep that in mind as we walk through. We're going to be mainly comparing last week and the run-up to it to other pre-Thanksgiving periods, which Dean has done an excellent job with here. So spot rates, again, are going to go up right before Thanksgiving and peak out as some of that final stuff gets moved this year more than ever. And again, we're almost $1 a mile higher, and I'm sure well over $1 a mile higher in a lot of lanes than the last 4 pre-pandemic years. West Coast ports are easing a bit. I still think it's kind of a crazy stat, right? You see 51 versus 86, but it's still, I mean, those numbers would have been probably in the teens, I would imagine, in years prior. Dean can correct me where I go wrong in a minute here. But again, average wait time to unload is still close to 20 days. It's sitting at 19. So by no means are we at a point of resolution on the West Coast from a port activity standpoint. And with that, I'll turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. So having a quick look at our data this week in the load board activity, the number of loads moved on our top 100 lanes were actually down last week. Of course, that's no surprise. Next week, we'll be saying they're up, down 24% last week. So they'll probably bounce back again last week. So it's really just a matter of looking at a comps over a full 5-day business weeks. Not surprisingly, the load-to-truck ratio dipped from 5.1 to 4.8 as a result of fewer loads last week on the shorter work week. Load post volumes are still 40% higher than the same time last year, so still lots of spot market activity heading into the peak holiday season. Similar story in the refrigerated market, although there was a lot more activity given Thanksgiving, a demand for reefer rates. Still healthy volumes last week. Normally we'd expect a decline of about 20% in load post volumes. It was only 7% last week. Rumblings of lots of grocers stocking up this year on inventory in anticipation of larger at-home gatherings during the holiday season. So the load-to-truck ratio was down about 15% last week to 9.90 from 11.65. In the flatbed sector, the number of loads on our top 78 busiest lanes declined about 9% last week. Again, no surprise there. The load-to-truck ratio dipped a full point to 34.7. That's about 10 points lower than the October average. Again, no surprise there given the seasonal decline in demand for flatbed capacity as winter takes hold. Having a look at our market condition index, Ken mentioned some of the data off the west coast. I flew in from Australia yesterday, and about the 13th hour into the trip, they start the long descent into the port or the Los Angeles area. It was interesting to note that there were a lot of vessels just sitting 150 to 200 miles out. It was quite a surreal sight to see the number of ships just sitting around waiting, but it's more of an optical illusion, as in the number of vessels that are decreasing immediately off the port because they're holding them further offshore, and more importantly, they're now slow steaming across the Pacific. So we've still got about 600,000 20-foot equivalent units sitting in the pipeline trying to get unloaded. So we're a long way from having that particular scenario play itself out. Spot rates in California, no surprise there, up 15 cents a mile last week. State average was around $3.55 a mile, excluding fuel. New record high on Los Angeles to Phoenix, which is where a lot of that warehouse e-commerce volume heads. Rates averaged $4.83 last week. That's excluding fuel. Up in the Pacific Northwest, of course, that bleeds into the British Columbia market also. When you talk about freight in that region, a lot of flooding rains closed down some of the rail lines for CP and CN. So a lot of truckload volume flipped over last week into the positive. Volumes were up 20% from Seattle to Chicago. That's a big intermodal lane. Spot rates are up for the fourth week in a row and are now averaging $2.68. That's up 29 cents a mile during the month of November. And of course, deep in Florida, it's not an area that carriers like to head, especially over a holiday weekend. Capacity was very tight for dry vans out of Florida. Spot rates are up 16 cents a mile to almost $2 a mile last week. In the refrigerated market, similar story to dry vans, but it's also the busiest week of the shipping season. Everybody wants Christmas trees in parking lots as of yesterday, effectively. So reefer spot rates in the Pacific Northwest peaked at $3.37 a mile last week. That's up 35 cents a mile over the last month. Seattle to San Francisco, rates averaged $2.64. That's up more than $1 per mile compared to the same week last year. And ahead of last week's festivities in Las Vegas, reefer rates hit a new 12-month high of $6.11. That's 6.11 excluding fuel. That's $1 a mile higher than the same week last year. Another big holiday destination over the break was Orlando, Florida. Spot rates from Atlanta to Orlando held steady at $4.18. That's up 74 cents a mile compared to the same week last year. Reefer capacity was also tight in Florida as winter vegetables start to come online. Shipping volumes are starting to increase ahead of the peak season that starts in Florida in December and finds its way through to about April. Spot rates are up 14 cents a mile last week to an average of $1.72 outbound. And in flatbed, capacity was tight in Florida. Also, spot rates jumped 74 cents a mile to an average of $2.94. It's quite high for flatbeds northbound out of Florida. In our top steel-producing state or market in Gary, Indiana, spot rates held steady at $3.33 a mile, where they've been for the last 2 weeks. They're up 15 cents a mile, though, on the Gary to Atlanta lane, averaging $2.70 per mile. That's up 50 cents a mile compared to the same time last year. One of our biggest flatbed markets is Houston. Capacity was tight. Spot rates are up 15 cents a mile to an average of $2.87. In fact, Texas capacity in Texas was pretty tight all round. And when we have a look at all of our markets, rates are up 27 cents a mile in Texas to an average of $2.91. So wrapping up with our year-over-year look at spot rates, despite the short week, there was an even sharper drop-off in carrier equipment posts last week. A lot of carriers took a lot more time off this year than they would normally. Rates have been fairly high, so I think someone took the opportunity to spend time with family. There was an acute capacity crunch as a result. No surprise, equipment posts dropped substantially. As a result, dry van spot rates peaked about 7 cents a mile last week to an average of $2.61. That's 34 cents a mile higher than this time last year. And in the refrigerated category, equipment posts dropped about 30% last week. That was compared to just 19% last year. So there was even tighter capacity against unprecedented shipping season demand during sort of the latter end of this pandemic. We hope spot rates ended up 4 cents a mile last week to a national average of $3.04. That's about 47 cents a mile higher than this time last year. And wrapping up with our flatbed, look, flatbed rates have been dropping steadily for the last 8 weeks. There was a little bit of an upward movement last week. They were up 4 cents a mile to a national average of $2.57 against the long-term downward trend. Compared to the same week last year, flatbed rates are still 33 cents a mile higher and about 35 cents a mile higher than 2018. So that's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update, and you can download our long form weekly market report. So that's it for the update, Ned. Over to you for the short-term forecast.
Before we get into the short-term forecast, I'd like to remind people that we love getting your questions. So if you have questions, comments, concerns, or burns for us, please do drop them in the chat, and our lovely and talented marketing folks will get them over to us. Without further ado, we're going to move on to the dry van forecast model. So this is kind of a hold on to your butts moment here. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast. In red, our short-term forecast is up and to the right by about 10 to 15 cents over the next month. As a reminder, this is heading right into the very end period of the holidays. So it's not that surprising, but it's still pretty aggressively up. Ratecast in green is expecting things to flatten out a little bit over the early part of December, and then when we move into the holidays, again, a pretty aggressive jump upwards. The blended forecast in gold and silver, or yellow and gray, I suppose, I don't know, the colors are weird on my monitor, are a little bit closer to the short-term forecast, again, expecting things to be going up. So that is something to be concerned about if you are very sensitive to dry van prices. Next, moving on to reefer. Pardon. We have another pretty aggressive set of forecasts, although there's quite a bit of model divergence here. In blue, you can see the market rates observed by DAT, and then off to the right, you can see in red our short-term forecast expecting a gain of about 10 cents over the next month. In green, our ratecast model is expecting a dip in the early part of December by about 5 to 10 cents, and then shooting back up, so a real kind of slingshot type effect as we move through the holiday season. That's not completely unexpected for December reefers, but be aware and try and do your best to make your rates. In gold and yellow and gray, our blended forecasts are leaning a little bit more towards the short-term forecast, but they're definitely taking this ratecast drop into account as we're moving into the early part of December. Finally, the most sedate of our forecast models is still pretty spicy. Flatbed in blue are the market rates observed by DAT. Off to the right, you can see our short-term models expecting things to stay steady, maybe a gain of a couple of cents over the next month, with, of course, a very sharp peak at Christmas time. The ratecast model is expecting that same flatness, but a much more aggressive upward tilt as we move into the right around the holiday season. And then our blended forecasts in yellow and gray are leaning more towards the ratecast model, expecting there to be a more sustained and more strong push as we move into the holidays. And with that, we are done with the short-term forecast, and we're on to our questions of the week. How quickly do you expect freight markets to recover after the holidays?
It's a great question.
Yeah, no, I mean, normally it's pretty quick, right? Like after the holidays, you get into the doldrums in the early part of January, and we saw that last year. And then it stopped.
Yeah.
So,
well, we had a polar. Texas froze.
Yeah.
Right. I mean, it wasn't like it did it all on its own.
Right.
That's something to keep in mind.
The thing I'm noticing this year, and again, my world is a small representation of the total market, but I have a bunch of friends that are sort of operators and carriers in all sectors, especially in the long haul sector. One thing I'm noticing in the last week, normally when you follow people on social media, you see lots of pictures of where they're loading trucks and how long they're spending at loading docks and things like that. Lots of pictures of drivers at beaches last week, drinking cocktails, having fun. Again, small data sample, but it's a trend that I'm noticing more and more this year. Rates are high. Carriers don't have to push as hard. They can afford to take more time off. So I think that's sort of been the story of this year. Whenever there's been a break, my anecdotal evidence would suggest carriers are taking more time off because they can. From an economic perspective, demand is high. There's no fear of catching back up again quickly. So I think it'll take a little bit more time to get carriers back into the market, more so than normal, largely because they can afford to take time off.
Yeah, I mean, traditionally speaking, right, you would expect, like if we're talking about the holidays being Thanksgiving and Christmas combined, that second week of January is when returns usually clear the system. Now, I don't know if that will be the case this year. We might want to tack on an extra week there. So you're thinking third week of January, things should start to seasonality should begin to exert itself, I would expect. The question becomes, though, like, what's the macro implication, right? Of like, when does the trend begin to shift and not, just the seasonal component?
Right.
And that's a little harder to predict.
Yeah, no. I mean, to echo your point, Ken, I think that we are going to see the seasonal patterns. It's just that there's these other signals that are going to distort. And the distortions, unfortunately, are in a lot of cases larger than the sort of normal seasonal patterns, and they wash them out.
Right.
I think that's right. I mean, we have these big macro factors, that both macro industry factors and then general macroeconomic factors at play, right? You have Class 8 truck orders. When are they going to hit the road? You have kind of the acute driver shortage that we're seeing, COVID related. You have kind of the broader macro talking point of the long-term driver shortage. And I think the big one that's not getting enough play really is inflation. Like how is that? I think we're running at an annualized 6.2% clip. Social Security cost of living adjustment was 5.8 or 5.9. We haven't, none of the trends that we've studied or we talk about on this show have really been studied in a high inflation environment. You'd have to go back to the 80s.
Yeah.
Trucking just becoming deregulated.
Yeah. I mean, I think that's going to be really interesting. Interesting in the not wild about that fact, because, I mean, hopefully it's, relatively, it's just the elephant going through the snake. But if you get these sustained self-reinforcing cycles, then that's going to have to change a lot of our modeling assumptions about like a relatively flat baseline with cycles laid on top of it. Instead, in a market where inflation is a real factor, you have to have a linear growth trend to everything. And you get this weird self-reinforcing, again, like, I don't want to speculate too deep outside of my wheelhouse, but I imagine at the point where somebody's going to be dropping the hammer on something, because I don't think they're going to let it get to like 7% year over year for more than 12 months. But
I mean, if you think about it, though, the mechanism, like basic economics, macroeconomics 101 would be the lever they're going to pull is interest rates.
Yeah.
Which.
Yeah.
I mean, in the markets that we study, that's going to have a very pronounced throttling effect, right? What happens when interest rates go up? Housing, you can afford less house, housing starts to go down, savings rates typically go up, which means you're spending less. So, on one hand, we know how to combat inflation using typical monetary policy. We don't know how to combat deflation, which is what we've essentially been dealing with for the better part of a decade. Yeah. But just because we know how to deal with it doesn't mean it's like a very pleasant experience. Ask Venezuela about, they were burning their cash money to stay warm. Not that you have to stay too warm in Venezuela, but again, you're paying $1 million for a Clark bar. That's like inflation run amok. So I think we're in perilous. Diesel, like I know that there's a lot of talk around what energy prices are going to do. Everyone's kind of formulating their 2022 hypotheses right now, whether you're an energy talking head or a freight talking head like us. I think what's interesting about the markets we study is that they're an intersection of all of these different things, whether it be inflation or fuel. Because what happens if diesel stays what if it goes to $5 a gallon for all of next year? Dean, what would that do to a trucker's P&L?
It'd probably blow it out of the water if rates weren't going up. It's sort of a similar rate. Right now, it's sitting around, diesel's around 26% of the cost of the revenue. So while it'd be around 25%, fuel as a percentage of revenue around 25 is pretty safe territory. But that could easily blow that back out to 2019 levels, where fuel was about 30% of revenue. So it's really about the relationship between spot rates on our side of the business and the diesel cost, not so much the cents per gallon.
That inflation piece is going to be something. I think that's my prediction for next year. It's kind of a cop-out. It's like answering a question with a question. But I think like the big thing we'll be talking about most of next year is how inflation specifically, or at least with a focus on energy impact, because contract rates are very much going to be subject to that inflationary pressure. Spot rates maybe a little less, but the fuel component will definitely add some, like a flooring effect. So we'll see. It's not fun, certainly not fun holiday talk. I mean, the price of eggnog is double what it was last year, but who's counting?
Yeah.
I mean, I don't know if anyone did any. I had to do some rapid fire Thanksgiving shopping because our Thanksgiving was rather disturbed. And holy cow! I mean, I could not believe the price. I don't grocery shop a lot. You know, we do the, what do you call it, the door Instacart or whatever. So like I'm not usually doing it. Just walking through the aisles on Wednesday before Thanksgiving, I was like, I could not believe how prices have went up. So I think it's something that's going to be a major story heading into next year.
Yeah, prices are up in sort of the wholesale catering business that my wife's involved in. Prices are up about 30% in the last 6 months alone. But the bigger story though is not just that prices are up; they're having to go to 4 or 5 locations to get the same volume.
Yeah, no, you're right.
Yeah.
I couldn't find a thawed-out turkey on Wednesday. Usually, like a lot of the places, historically speaking, would turn their freezers to refrigerators like on one Monday.
Yep.
And I think a backup story, which is going to be really interesting to track, is going to be like this overstock thing. We were in Costco on Black Friday, and first of all, no one was there. It was slower than a normal Friday morning. I mean, we got there at 9 when they opened. Hardly anyone there. Absolutely nothing on sale of any importance. The only thing people were buying were like Christmas wreaths. And they had an entire 2 rows of fresh turkeys basically free. I mean, they were offering like $15 off an $18 turkey. They had clearly over ordered to the tune of probably what looked to be over 100 turkeys. Right. So, I mean, as easy, there's a lot of, if you read the tea leaves, there's a lot of indication that a lot of retailers are going to have severe overstock heading into Christmas proper.
Yep.
Because they're just not, I don't think people are spending. I heard Cyber Monday was okay, but I think that was due to the main driving factor there was a higher average selling price and lower volumes. Yeah.
And the story that I think hasn't played out, Ken, is a lot of the delays in getting imported freight in for specific holiday season events. So there's a timing component to when shippers order this volume. And we've already seen instances where spring volumes were late through the summer. Summer season inventory was late. And now you've seen, I think the Lodestar reported, or maybe it was the Journal of Commerce, had a great story about how some of the shippers are now trying to find space for fall shipping season volumes with winter inventory. So now you've got warehousing issues and inventory being moved through multiple locations until it finds a home. I think we're going to see that play out even more so next year, given that we've got so much import volume in the pipeline.
Yeah, we'll see. I mean, we got to schedule our Nostradamus episode before the end of the year.
Right.
All right, we have some questions coming in, Ned. You want to hit us with those?
Yes, absolutely. Peter Austin asks, people say contract rates are usually higher than spot. I'm a single truck carrier, and I always get offers to run consistent lanes that seem to offer less than I'm used to. Any idea why? Normally, this is so, but I would say that recently, I mean, not to go too deep into the weeds here, but spot rates have outpaced contract rates for a while now.
Yeah, and it's important to designate when we talk about spot here, we're talking about essentially like the broker to carrier spot.
Yeah.
You might also see reported the shipper to broker or the shipper to carrier spot, which would have essentially the margin built into it. So it would be 15 to 16.5% higher, right? So if you're a shipper, what you're typically experiencing are spot rates higher than contract, and right now they're a lot higher. But if you're a carrier, what you typically would experience is spot rates a little bit lower than contract, and right now they just happen to be higher.
Yeah.
Because think about it, right? You are taking a premium to lock in the price of your capacity going forward in an uncertain market. That's why, from a carrier's perspective, contract is almost universally higher than spot, right? So think about it that way.
Yeah.
Maybe Peter could send us a note to at our website just so I could have a dig into some of that specific lane data that he's asking about, so we could answer that properly.
Yeah, askiq@dat.com is the email to target, and we're happy to do a little bit of shoe leather reporting to the extent that making a database query is shoe leather. But we also have another question from Peter. Any speculation on how electric trucks, Tesla specifically, that can run in a convoy with less drivers will affect us? Are there any concerns? I mean, like 5-10 years from now, maybe. But like, I am kind of a prematurely grumpy old guy, and I have been seeing a lot of talk about self-driving vehicles for a while now, and the kind of result of this has been not as powerful a shift. Like, I think at some point it is going to happen. I wouldn't necessarily lose any sleep about it right now.
Yeah, I'm not concerned about it at all, Peter. It's a great question because there's lots of talk out there. There's lots of technology adoption and acceleration during times like this. A little bit of the problem with the convoying, the closing up of the gap between trucks, reducing the drag. The problem with that is the economic model hasn't been developed fully. And that works when you've got two trucks from the same fleet following each other. Again, if you go out on the highways and look around, that's a fairly low probability, unless you're in the LTL sector where you've got a hub and spoke model. But in the truckload sector, the economic model doesn't work where you've got two trucks from different fleets, one drafting the other, and there's no share in the economic gain from the fuel savings. Until there's a model that can actually share the savings electronically between two trucks that aren't from the same fleet, I don't know that that'll work as effectively as it should. It's a great idea, and should be, we should see wider adoption as we get closer to the level 4 and 5 autonomous truck level. We're a long way from that just yet.
Yes.
What they said.
I mean, it's a really hard problem, and the advances that have been made in like lane keeping and just general quality of life maintenance are non-trivial, but you're gonna need a human in the mission, a human in the car in the truck for quite a while.
Yeah. The other thing that I've noticed is all this talk about autonomous trucks seems to pop up every time that there's the driver shortage is sort of perceived more clearly than other times. Again, the economic business model, I don't think it stacks up. I'm seeing some of the AV players being very bold about talking about replacing drivers completely. Having done a few million miles as a driver, I just don't know how that's physically possible. But again, from an economic point of view, I just don't see the economic model, how it stacks up, given the expense of those vehicles and the need to build hubs outside of major cities. Again, I'm happy to debate that with anybody that's got some more information, but I want to see the economic model that supports autonomous vehicles and the convoying of vehicles in particular.
Yeah, at the point at which the vast majority of freight is drop and hook, then I'd start to see like less of a call for we have Sudhir Pamidighatam. Sorry, Sudhir. I did my best. But how much did the van truck post decrease last week compared to previous years?
I could tell you right now. I could look at, just excuse me looking away from the camera, but load posts last week for all three equipment types were down 35% week over week. But interestingly, 37%, I'm looking at the wrong line, 37% year over year is the decrease. So we've seen, sorry, I've got that wrong. So if I combine all three, it was 41% fewer load posts last week, but 37% more than last year. So just double check that formula. More than
it's only a 2.5 day week, if you think of it. I mean, that's how I thought about it in the industry, right?
Yeah, definitely more load posts last week versus all the previous years. A little bit more than 2018, about 10% more than 2018, which was sort of that last year of peak demand.
We've got a question from Odie Gary. Are port disruptions in California due to the state's EPA laws on emissions not allowing older units in to move containers, or just a lack of workforce?
It's both. It's part of that. They're part of the story. I think
it's a combination of a lot of things, right?
Yeah. I think the biggest though is it's a space issue. That's the biggest thing. It's a physical space issue. Now you're talking about massive backlog of empty containers being stacked in all sorts of places because they can't get into the port because the ports are full of loaded containers. So I think it's a space issue more than anything that's affecting the whole industry. That includes railroads and intermodal ramps that are all sort of choked up also.
Yeah, I mean, I'd love nothing more than to blame the problem solely on California bureaucrats, but I think there's a little bit more to the story. Not much more, but I think there is more to the story. They just delayed again the excess dwell surcharge, didn't they? Did I read that this morning correctly? That they're delaying it again?
Right. Yeah, they are. But it's also like unfortunate timing. It's a bit like just before the pandemic, they brought in the Drug and Alcohol Clearing House, which sort of effectively takes lots of drivers out of the market. Similar thing with the EPA laws that were enacted years ago came into effect in 2020. So some of those older trucks that would normally sort of be rattling around the ports, there's fewer of them there unless they're incredibly healthy older engines. And they have
so what you're saying, Dean, is, I know this might shock our viewers, so make sure that you're prepared for what I'm about to say, is that the government isn't understanding the full consequence of their decisions before they make them? What?
It's a bit like the ELD mandate, right? Unintended consequences. So we bring in this rule where you've got to have a 30-hour break at the 8-hour driving mark. So at 7 hours and 29 minutes, we're seeing drivers pull over on the breakdown lane of interstates because they don't want to get a violation in the worst place possible, increasing accident risk. Like unintended consequences of regulations where they're attempting to make the roads safer actually do the opposite. Big shock, of course.
Your tax dollars at work. All right, what else do we have going on here, Ned? Anything?
Nothing else in the question pipeline. Do we have any shout outs that we want to make?
Yeah, I do.
Dean?
I'm on the Mark Willis show today at 2 p.m. Eastern on Road Dog, and then on the Radio Nemo show this week at 8 a.m. on Thursday morning, talking about all sorts of things ranging from preparing for winter driving and comparing and contrasting the US and Australian trucking industries.
Oh, that'll be cool.
Yeah,
that's got to be really, because Australia, it's so bi-coastal, right? Like you've got huge amounts of just dead miles.
A lot of empty miles of nothing. Yeah, a lot of straight roads. But you have some pretty big combinations. You can, your typical combination there is running about 150,000 pounds on 9 axles versus 18, five axles here and 80,000 pounds on worse roads. So
yeah,
we could learn a lot from Australia in that regard.
All right, so with that, I guess I'll wrap us up. I would highly recommend checking that out. What Dean mentioned, we have, what else do we have? I know that I'm missing something. We'll figure it out. We can post it up on LinkedIn. So we plan to be at least a couple more shows before. I know that the weeks we have a kind of, with Christmas falling on Saturday, the schedule is going to be such. I think we only have 3 more potential weeks to even have a show. I think we're going to try to do all 3. But we'll keep you guys posted on that. Yes. You can check out Dean's full market update on the website. What's the address for that, Dean?
DAT.com/market update. Type that into your browser. Yep.
Yeah, for sure. The FMIC Pulse report comes out today or tomorrow. So if you're a shipper, that's a really cool thing to check out. Ina Mayub and Chris Kaplis and team pulled that together, always chocked full of awesome information. And I think that is it. We'll be here next Tuesday at 10 a.m. Eastern, and we hope everyone has a great rest of your week. Bye, everyone.
Yep. Bye.
Bye.